Hey guys, this is John from Christos Capital. We're talking about risk management, so check it out. Profit limits and stop losses. Every time you trade stocks, forex, whatever, you need to make sure you place profit limits and stop losses, okay? That means that if you place a trade, you're willing to risk up to, let's say in forex, up to 10 pips. And then if it hits those 10 pips, it cancels out and you don't keep losing. Why? Because, let's say, check out this chart. Let's say we place an order right here, correct? It's come down, and let's say you put it for 10, but before it hits 10, it climbs up and it hits your profit limit, okay? As soon as it hits your profit limit, it closes off, and you made your profit, and you're good. But check out scenario number 2. It came down, and instead of going up, reversing, it keeps coming down, right? If you didn't have the stop loss, now you're losing even more money instead of just those 10 pips and whatever those 10 pips mean to you, or those 20 pips, right? So that's why you put the stop loss. The profit limit, you want to put a profit limit, and that has to be not just a guess of how much, it should be calculated. Because check this out, what happens if it goes all the way up, you don't have the profit limit, and you're like, oh, let's keep making money, and all of a sudden it drops back down to where you started. All that money that could have been already in your pocket now is back to break even. So you want to make sure you place profit limits and stop losses because of that, okay? So now, with risk management, we got to talk about risk to reward ratios, okay? So if we're doing, let's say, 10 pips stop loss, 10 pips profit limits, that's 1-to-1 risk to reward ratio. Or it could be 20 and 20, that would still be 1-to-1 risk to reward ratio, okay? So that could be in the sense of, in the stock market, let's say, $10 to $10, right? Or $100 to $100. But in this case, 1 is going to be 10, and then everything else will do the math in the fractions, okay? So if you're 1-to-1 risk to reward ratio, you need to be 50% correct in order to be break even. If you're 1-to-3 risk to reward ratio, that means 3 is the profit and 1 is the risk. That means you need to be 25% correct. And 1-to-5, that means you need to be at least 17% correct to be break even. Okay? Higher than that, 60, 50, 40%, that's already in profits, as you guys can see here. Okay? And with that being said, I want to let you guys know that, sure, you don't have to be the best trader. You don't have to be 100% correct all the time. Like, let's say out of 100 trades, you don't need 100 to be correct. But that doesn't mean that you don't want to strive to have a good percentage of trades being correct, right? I try to strive for at least 70% of my trades to be correct. That's my goal. So if your goal is 70% with 1-to-1 risk to reward ratio, this is what you're going to be looking at making if it's $10 to $10, right? Out of 100 trades, right? And this is what you're going to be looking at 1-to-3 risk to reward ratio out of 100, and this for 1-to-5 risk to reward ratio out of 100 trades, okay? So that's the risk to reward ratio for everybody. It's going to be different. It depends on what you're trading. Thanks.